about to drop the hammer and dispense some indiscriminate justice.
Good morning, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3 or $10 for the hard copy. You should buy it, otherwise you'll be a broke loser for the rest of your life. And hater of degenerates and clowns on YouTube that have no idea what they're doing when it comes to investing in stocks. They don't know what a 10K is. They don't know what a financial statement is. They don't know anything. They're just a bunch of losers that pump random stocks that everybody else does. When in fact, you should be looking at a stock's fundamentals to actually see if it's a good deal to buy at the current time. Because that's what matters in the long run, you degenerates. Anyway, today we're going to talk about Apple's consolidated statements of operations. What is that? This tells you Apple's revenues and expenses and profit for the year ending September 26, 2020. Every company basically tracks how much they've made and how much they've spent on the accrual basis of accounting for an entire year. That's how you figure out a company's profit or loss for the previous year. Compare that to the balance sheet, where that's just a snapshot at a point in time. The income statement is important because you want to see if the company's profitable and you want to see the accounts that are affecting that profitability. It's very important to look at trends in revenue and expenses to be able to project in the future what your company is going to be doing. How profitable are they going to be in the future? Because you don't really know what the future holds, but you can make reasonable guesses about what the company is going to do, and you can use that knowledge to project the stock price, or to see if the stock price is currently trading at a good valuation. Which, in my opinion, I think Apple's a little expensive. I'll probably do a video on that. But today we're just going to teach you, I'm going to teach you about the consolidated statement of operations, the income statement, because you need to learn how to read this. Now, the income statement it always begins with revenues, which is what the company has sold to its customers. Revenues are recorded when a good is delivered, somebody delivers it or receives it and accepts it, or when a service is performed. It does not record revenues when cash is received, because in the accrual basis of accounting, you record revenues once you've actually done the work or satisfied a performance obligation. The example I like to use is mowing a yard. Let's say your neighbor wants you to cut their grass, and you say, okay, I'll do it, and you go cut their grass. Well, if the neighbor hasn't paid you yet, have you still cut their grass? Yes. Have you performed the service? Yes. Therefore, you have earned revenue. You would record revenue on the accrual basis of accounting, even though you have not received the cash yet. Do you get it? There you go. Now, on Apple's consolidated statement of operations, they actually have 3 years of revenues. What you can do with this is see trends in revenue growth. And it's actually really nicely laid out because they divide it into products and services. When you're analyzing a company, you want to look at trends in both. You can't look at trends in overall revenue necessarily, because maybe service revenue is growing faster than product revenue. You have to account for that when you use your projections for revenue growth going into the future. Now, what trend do you notice about Apple's revenues? Looking on the far right, we have the year ended September 29th, 2018. So this is all the revenues they've earned from September 29th, 2018 to September 29th, 2017. They've earned $265 billion. And the next year, they earned $260 billion. And then in 2020, they earned $274 billion. So they had a little bit of dip in 2019, but over time, it seems like they've grown their revenues. Now, that is the top of the income statement. That is not profitability. Just because you've earned revenue doesn't mean you've made all that in profit, because you have expenses. Now, your expenses are divided into operating expenses, which are down here, and cost of sales. Think about it this way. Your cost of sales is using an iPhone as an example. The cost of sales for an iPhone is all the direct labor that went into building it, all the materials that go into the phone, and all the overhead at the factory that it costs to put into the phone. That does not include stuff like the CEO's salary, the administrative offices, selling expenses, all that stuff. That is not included in cost of sales. The only thing included is direct materials. What goes into, see this beautiful phone with the cracks on it? What goes into this phone, all the materials, the labor, whatever, slave labor in China was working on this phone, the cost of that labor, and the overhead for the factory. That could be the factory supervisor, depreciation on equipment, depreciation on the factory, insurance, rent. All of those costs get put into this phone. And this phone is recorded as cost of sales, the cost to actually make this phone. Because if you think about it, if you're making a phone, you want to track the cost because you want to sell it for higher than it costs you to make, because that's how you get a profit, okay? Now, what it gives you is if you take your revenue, let's say product revenue is $220 billion for 2020, and you subtract out the cost of all those products, what it costs to make those products, $151 billion, that gives you your cost of sales. You want to look at those separately because that tells you your gross margin. Your gross margin is what you sold the product for minus what it cost you to make it. That tells you your profit without considering anything else except the cost of the product. Does that make sense? So here on the bottom, they combine the gross margin, which you literally just take total net sales minus total cost of sales gives you your gross margin. That tells you your top line profitability without including other expenses. Now, you want to look at these separately because they have cost of sales for products and cost of sales for services. You want to look at those separately and get each margin because then you're able to project what the margins may possibly be for products and for services. Now, moving down. Next, we have operating expenses. These are all the other business expenses except for interest and taxes besides what it costs to make the products or provide the service. So you have research and development. In 2020, it was $18.7 billion, $16 billion in 2019, and $14 billion in 2020. And then you have selling, general, and administrative expenses. So salaries of salespeople, maybe shipping charges, stuff like that. That's all captured in your operating expenses. That's distinguished from the cost of sales. Remember that. So when somebody talks about the gross margin, they're not talking about what it costs Apple to do research and development or what it costs to do selling, general, and administrative expenses. So you want to factor that in. So to calculate your operating income, you take your gross margin minus your operating expenses. That gives you operating income. Now, hopefully that's a profit because that is the profit you get from all your operations before you factor in interest and taxes. Now, the reason this is important and you want to know what operating income is really depends on whether you've lent Apple money or you're a shareholder. If you've lent Apple money, the operating income is basically what Apple can use to pay off interest because that's what you want to receive from the debt. If you're a shareholder, you want to look at the bottom line net income because you don't get the operating income. Apple has to pay interest from the operating income because bondholders get paid first, and then Apple has to pay those delicious taxes that we all love so much. After Apple pays all of those, then you get your net income, which is then able to be used to be paid out as a dividend or to be reinvested back into the business, okay? So you want to keep that in mind. So starting from the top, we have net sales, revenues, products and services. Then we subtract out our cost of sales, what it costs us to make the products, $104 billion. Or sorry, the $104 billion was the gross margin. The cost of sales was $169 billion. Then we have our operating expenses, CEO, selling expenses, research and development. We subtract that out to get our operating income, $66 billion. Then we have to, they accounted for other income and expenses. I don't know what that is per se. You have to look in the notes of the financial statements. Could be like random gains or losses on investments, stuff like that. Then you have income before provision for income taxes. Then you have income taxes. And finally, you have net income, which is your bottom line profitability. This is what matters. Net income. Your freaking gross margin doesn't matter because you have other expenses, aka operating expenses. Now, the last thing, this is very important, is earnings per share. Because whenever you buy a share of Apple, you only own one share. And whatever earnings are attributed to that share are what you are going to get for the year. Now, this is what this tells you. There's two things here. There's basic and there's diluted. To calculate your basic earnings per share, you take your net income, which let's say in 2020 was $57 billion, minus any preferred dividends, because those are dividends that are paid to preferred stockholders that have a priority over common shareholders, divided by the weighted average common shares outstanding, which is the number of shares that are outstanding throughout the year, and they factor in shares that were issued or purchased back. It's a long formula to figure that out. But what that does is that tells you how much of earnings you get per share for the year. So if you own one share of Apple for the year ended 2020, you got $3.31 of earnings, okay? And you can figure out the price to earnings ratio by taking the price of the stock at the current time divided by the earnings per share, which I think Apple's PE ratio is like in the 30s or something like that, which is kind of high. Now, that's basic. Diluted factors in potential things that could create more common shares that could dilute or reduce the amount of earnings that you get. So you want to factor in diluted earnings per share because there's a chance that stock options could be exercised, bonds, convertible bonds could be converted into common stocks, stuff like that. So you want to factor in and say, okay, worst case, what is the lowest possible earnings per share that I could get? In Apple's case, there's not that many dilutive securities. So worst case, you're still going to get $3.28 of earnings per share of Apple stock. And then finally, they have shares used in computing earnings per share. Now, the formula to calculate shares, it's a pain in the butt. I mean, maybe I can do a video about it. But what you want to look at is kind of see the trend in shares. So if you go look at 2018, they had a weighted average common shares outstanding of 19.8 million. And then it goes down the next year to 18.4 million. And then it goes down to 17.3 million. What that tells me is they're buying back shares, which is a good thing. Okay? So that's it. You need to understand how these statements work. You can't just look at revenue and be, oh, the revenue went up, so that's good. Because your revenue could go up, but your gross margin could go up even faster, which means you're actually making less profit. Same thing with operating expenses. You could have explosions in operating expenses. Maybe you're paying your sales staff too much. Maybe you're spending way too much on R&D, stuff like that. That's how you really understand your bottom line profitability, which is net income and earnings per share. Because at the end of the day, you own a share or two of Apple, and you want to know what you're actually getting. Well, they're not cash flows necessarily, but what you're actually earning every year for owning a share of Apple, because you own part of the business. That's it, ladies and gentlemen. If you like this, please like the video, subscribe to my channel, drop a comment if you have any questions about anything that I talked about, and stop listening to these freaking morons on YouTube that have no idea what this says. You think Chris Sane knows what a income statement is? You think Keenan Grace looks at this? You think Stockmo knows anything about the accrual basis of accounting and how to look at financial statements? Of course they don't. They're degenerates. They're losers. They're charlatans. Anyway, y'all have a wonderful, delicious day.